Hello. I just wanted to do a super quick video on as a follow-up to my thoughts on de-escalating risk, and I did not show the downside of de-escalating risk when you're losing. It sounds really good and clean, like it's a fair thing to do to de-escalate risk when you're losing and you are performing at negative edge. So let's just de-escalate risk. Let's do that. And the problem is during the sideways environment or somewhat positive, somewhat negative, you go down more. And I'll show you the graph exactly what that looks like. And then also the issue is that you can't de-escalate risk without increasing risk too. So if you're risking $100 and you have to de-escalate risk 75, 50, risk 25, okay. What happens when you start winning? Are you still going to risk $25? I don't think you can because you can't de-escalate risk more than that. You know what I mean? So you have to have a risk that goes up and down and back up again. And um, it's not always profitable. And I'd like to show you on trade number 177. I'll just take a screenshot here. I'll show you. This is just random results, just like I showed in the last video. I just want to show that 177, zone number 177 is right here. You can see that it rallies on pretty much every chart because it is the same underlying data. On the left-hand chart is de-escalating risk, increasing risk every single trade. Okay, if you win, you double size. If you win, you double size, and there is a cap. Same on the bottom side. Um, on this chart in the middle is just standard risk, -1 or +1. You win or you lose. Simple as that. And this is a 50-50 win rate. It's actually 57% win rate, but there's about 300 trades here, 250 trades. So for a 1 hour. And then this graph on the right here, about 177's right here. You see this one is a little bit different where you if you're underneath 5R, you're risking 1. If you're underneath 10R, you're risking 2. And then if you're over that, you're risking 4. Okay? So you're not basing it off your just your previous win. You're actually basing it off of your actual value in your account. And I'd like to compare the graphs here. And just for the sake of simplicity, let's just look at the rally upwards. And then if you look at the standard chart in the middle, you see that it's not necessarily negative edge here. This section here is not negative edge. If you can see this, there was a series of 50 trades or so, and I actually just looked at the string of numbers of win or losses. It's literally 50%, exactly 50%. So this section that I circled is a 50-50 win rate. Where you can see on this chart where you de-escalate risk when you're losing, you can see that this does not look like 50-50, does it? This looks like tragedy. That's what that looks like. And that is de-escalating risk when you're losing. How is that possible? Well, there's different ways to de-escalate risk. This is de-escalating every single trade and then escalating every single winning trade. It's a trade by trade basis. It's really, really quickly, and that's why it shows very volatile. Um, it escalates risk really quickly. So it attaches to your winning rate. All right, you're winning now. Let's go, let's go, let's go. And it's really quick. And if, like I said, if you lose at 8R risk, then you go down to 4R risk. You win at 4R, but then you lose the next trade. You're losing 4R, but or sorry, you're winning 4R, And then it goes to 8R risk because you double risk when you're increasing, when you're winning, but you lose. You don't go on a winning streak. You lose. You actually lose double the amount that you win, and that's why that goes down. And I didn't really understand that till now, really. Now, what chart would I choose? I would choose this one. I really like how, yes, it's a 50-50 win rate, and yes, I get to de-escalate risk. You see all these trades here, underneath here. They're smaller up and down movements because you're risking 1R. But if you get above 5, you can see that the chart does get a little bit bigger. The movements gets a little bit bigger because you're risking now 4 times the amount you were risking when you just started the account. And I think that this is better because at a certain point, it is all about protecting your account. And this chart on the left is not necessarily interested in that. It's more so interested in just the trade by trade basis, where this account on the right is the rules for position sizing is based on the account value. So I really like that. Yes, we get more drawdown. We do if we win inside the 2R, we only win 2R, right? And if we jump between 2 and 4, 2 and 4, 2 and 4, you'll go downwards. But eventually you'll get to 1 and now you'll risk less, you know? Um, Whereas this one on the bottom here, if you're at break even on your count value, if you increase 3 trades in a row, you're at max size, 8R, you're at 8R risking when you're not actually ahead that much in the account. Um, so I don't think that this is smart on the left-hand side. I do like the escalating risk and de-escalating risk, but I think there needs to be a balance to it, and I think that's the one on the right here. The one in the middle, risking 1 to make 1, yeah, you can just do that too. It's very, very basic. Um, I just think that there's more optimal ways to do this than just risk 1 to make 1. You know, I think there's position sizing that can just be more efficient than that. If we know our underlying data, if we can predict our underlying data to a certain extent, um, meaning our trading results, like we know our win rate, we know generally what happens, what can happen, there might be a way to do better than just standard risk. So yeah, that's all I had. Um, Definitely interesting though. I like the idea of basing it on the account. So, all right, peace.